Welcome back to the channel, folks. This is Jason, Certified Financial Planner, host of Fighting Words Financial. Today, I'd like to talk to you guys about a market crash. And let me be clear right off the bat, I'm not predicting a market crash this year or anytime. What I want to talk about is what happens when the ride comes to the end. And the ride has to come to an end at some point with this market. And let's talk about that. But before I get started, let me tell you that this is one of the unscripted videos that I always intend to be sort of tightly focused and relatively brief, and it never ends up that way. So why should we expect this one to be any different? But let's talk about market crashes in general, and let's talk about sort of the current feeling that most investors have right now, at least the people that I'm talking to. And I talk to investors all the time. I think you guys know that I'm in private practice somewhere. I just can't mention where on a YouTube channel, but let's talk about that. We have not had a real market crash now for 12 years. The market has been 99% good over the last 12 years. And other than the blip that we had from mid-February of last year to late March, early April, so really a 7-week period, the market has just gone straight up. It's created this phenomenon that's not unique at all. In fact, it's a phenomenon that has existed throughout all of time, as long as there's been investing, this phenomenon has existed, and it's this. Everyone is a genius in a bull market. Everyone's a genius in a bull market. Right now, everyone's sitting on a mountain of gains that they made this year, and it's been almost impossible to lose money since March of this year. The fact that the market could be down 30% at one point and then be up 15% for the year is absolutely remarkable. There's a lot of factors that have affected that. It has certainly not been a robust economy that has triggered that. It has been more related to liquidity created by the Federal Reserve, easy money, easy access to loans, that sort of thing. But let's talk about this phenomenon right now. And I guess the best way for me to relate this is to talk about, basically it's story time. I know maybe you guys don't like that, maybe you do, but let me relate this to a time back when I was a really young man. This is a long time ago, late 1990s. I was not working as a financial planner. I was working as a programmer for a company that basically housed day traders. So when I would walk into my office in the morning, I had to walk through the trading floor to get to my office where, I did new programs for new things that would enable traders. And occasionally I would fix problems too with people's computers, but mostly I created new things. And I thought it was really exciting to walk through that office and see these guys with like 4 screens at their desk with their Bloomberg screen over here, their NASDAQ screen over here, all of their news and information. And they were trading on moves of less than $1. I know that sounds ridiculous today, but they were trading on moves of less than $1. And these guys paid, $50 or $60 per trade commission. Okay, so $50 or $60 per trade, commissions back then. It didn't matter if it was 100 shares or one share. They were paying like a $50 or $60 commission depending on their volume of trades. So the more volume of trades you did, the less you paid in commissions, as an absolute amount. But it was crazy now that I think about it, how much they were paying in commissions. But anyway, on one particular day, I had to do work in someone's office, and so I was in a meeting while they were talking about, it was a couple of older advisors there and a couple of younger day traders, and they were talking about how to prepare for an eventual market crash and how to prepare for when things don't go right and the market only makes 1 or 2%. And the younger traders kind of looked at each other and they got this like derisive look on their faces. They sat back, they crossed their arms, and they're like, we made 20% last year. So let me give you a little context. Like in 1998, there was kind of a mini crash, like around April. The market went down and the market came back up, kind of like now, right? There was panic over how much money had poured into dot-coms, and people pushed aside that panic and dumped more money in. And these guys looked at these older traders and were like, we made 20% last year. We're going to make 20% every year because, we're smarter than the market. The older guys looked at them and it was a look of pity. And, I was already investing at the time, and I'm one of those people that reads books and really gets into the literature of something, before I start trading, before I do anything. I really research the industry. And I knew at this point kind of how markets worked and how stock picking works, how investment management works. And I'm not even a professional. I'm looking at these guys. I'm like, you're crazy if you think you're going to continue 20% gains year after year until you retire, which is exactly what one of them said. And I remember just finishing up and saying, okay, These guys are in for a rude awakening when we do one day have a market crash. That didn't happen for another year and a half, and by that time, I didn't work for the firm. But years later, when I started thinking about this, I understood at that point that they couldn't be blamed for thinking or feeling the way that they felt, because these guys were maybe 23, 24 years old. A rich uncle or something, or one of their best friend's fathers gave them $500,000 and said, this is an arrangement that was completely illegal, by the way, but they gave them $500,000 and said, you trade this money for me and we'll split the profits 50-50, right? So not allowed, absolutely illegal, and they shouldn't have been doing it, but this was happening all over day trading houses back then. And so, but here's the thing, they may have started trading in stocks in 92 or 93, maybe 94. By 1998, their only experience had been in a bull market. Their only experience had been in a market that went straight up, with this one little blip in 1998 where the market crashed briefly a couple of thousand points and then was back up in a month and a half, 2 months. What does that sound like? That sounds a lot like today, right? Then along came 2000, 2001, 2002, where the market was down 9%, 11%, and 22%. 3 years in a row, the S&P 500 saw losses. Down 9% one year, down 11% the next year, down 22% the year after that. It would have been very hard for any investor to maintain, or it would have been very hard for a day trader to maintain any sort of discipline in that time period. It would have been hard for any sort of person who's not really focused on the long term to maintain any sort of discipline in that time period. And yet, there were plenty of opportunities to grab stocks in that time period at a valuation that would later explode. Right now, we're in the same sort of period, but it's even worse to a degree, because the market has not really seen a long down period or a market crash in 12 years. We've essentially had a long period of expansion, the market going up, up, up. We've had one brief moment in 2018 where the market lost maybe 4%, and then one sharp decline in 2020 where the market was down huge and then bounced back over the next couple of months. It's created this environment where everyone who bought Tesla thinks that they're a genius at picking stocks. Everyone who bought NEO thinks they're a genius at picking stocks. I'm no different. I own both of those things. The difference is I've been through periods where my belief or my confidence in my ability to choose stocks has really been tested. And we haven't reached that point. It's not going to be that sharp downturn that really tests your resolve as a long-term investor, because a lot of people like me will see that as a buying opportunity. A lot of people who are invested for the short term are really going to see this. It's a buying opportunity whether or not you're a short-term investor or a long-term investor, but that's not what's really going to test their resolve. And look, what happened in February, I happen to have, by mere coincidence, a large amount of cash sitting on the side in February that I was worried about a tax issue that hadn't been resolved. That tax issue was finally resolved. The money was free and ready to go right as the market crashed. Total coincidence. Has nothing to do with how smart I am or how stupid I am. It has everything to do with how lucky I am. And I was able to invest those dollars right at the bottom. And I made some choices on stocks based on what I was interested in, based on what I knew, and based on what I considered the future was. Basically, I made choices based on being a nerd, and it's paid off. I recognize that is more good fortune than it is any sort of skill on my part. And I think that a lot of people investing right now fail to realize that you aren't skilled, you're just lucky. That this is a bull market. Everyone looks like a genius in a bull market. It's been damn near impossible to lose money in a bull market. It's created some really odd phenomenons. I was having a conversation with an investor who I work with who claims to be a bit of a contrarian, as I am. And we were talking about unloved asset classes right now. And I'm looking at residential REITs, for example, where most of them are still down 10% for the year in a year when the market is up 15%, and the real estate market is considered to be hot. Right? The real estate market being hot, which that's a really broad term, by the way. It doesn't really necessarily apply to every sector of the real estate market, but the real estate market is hot, and residential REITs are down about 10% when the regular market is up 15%. The investor that I was talking about was saying this is not really a great opportunity. It's only down about 10% since the sort of market crash we had last April. And I'm looking at him and thinking the delta between positive 15% gains for the S&P 500 and negative 10% for residential REITs, that delta is enormous. I mean, that's a 25% delta. Really, this represents an asset classes that is absolutely ignored in this time period because very little about the fundamentals of that asset class have changed. People are still going to need to live in apartments. Eventually, moratoriums on evictions are going to expire. And if you look at occupancy rates, rent collection rates, they really haven't gone down that much. There isn't a reason for this not to have gone up with the rest of the market. Like not that I say that it should, but there isn't a reason, logically speaking, that it shouldn't have gone up. But the perception in this investor's head that this asset class didn't represent a opportunity because it was only down 10% when the rest of the market was down further in that time. It was a really strange way to think of things, and it wasn't very sound mathematically, and it wasn't really grounded in the reality of how investing works. And it got me thinking, and that's really kind of what triggered this whole series of thought, is that we're entering a period right now where the psychology of the investor is entering into a dangerous point. Most people think that they are experts at this game. And I think that you need to realize that not being an expert, not experiencing a market downturn, a real long flat period where the market is down for a year and a half, 2 years, that is now completely outside of your experience. You don't know what it's like to go through it. And if you get caught out by taking a large risk, by putting if you are investing in a stock that you don't think has long-term potential by taking out, by using margin and borrowing a lot of money to buy it, meaning you think you're just going to go up 15% in the near term, 20% in the near term, you want to capitalize on that short-term trade, you borrow $100,000, buy a stock, boom, it's down 15% and stays there for a year and a half. What are you going to do? Are you going to eat that loss? Here's the thing. There's nothing wrong with eating a loss. There's nothing wrong with... The problem with investing is people want to match what they think their friends, neighbors, and other investors are getting, and they just want to win. Just wanting to win is kind of a feeling that's very dangerous for you if you don't know when to cut your losses. And this is going to be very, very important going forward, especially not for a long-term investor, because I don't care what the near-term movement of a stock is. But for someone who's not focused on the long term, who is focused on turning on a short-term trade, not knowing when to cut your losses may be disastrous indeed for your portfolio. The other thing that's created this environment is the tendency for a newer investor to take more and more and more risk as success confirms the bias that their genius is responsible for their all the gains they've made in the market. Not counting the fact that it's really the bull market that was responsible for a large part of the gains that you have in the market, right? People tend to pay attention to what their neighbors are saying, what their friends are saying. They maybe are a little bit jealous of the fact that, hey, maybe I made 15%, 20% this year. My neighbor says they made 400 or 500% this year. I want to get those kind of gains. I'm going to take the same sort of risk that they're taking. And I'm seeing more and more of that happen, especially with the hysteria around all the SPACs and now the sort of new hysteria that's going on with some of the genomic stocks, which, by the way, I'm hugely into genomic stocks. I'm going to do a video on that later, but I'm looking at it from a different perspective than most people are, and we'll talk about that. It's created this tendency of people to take more and more risk to match what their neighbors are doing. And that's very, very dangerous too, for a couple of different reasons. Number one, some people just get lucky. But number two, a lot of people lie about what they make in the stock market. In fact, there's a lot of academic research to back this up. There's been study after study after study that suggests that people exaggerate by about 50% what they make in the stock market, both professionals and amateur investors. Luckily, that's why we have reporting requirements for people who run ETFs and people who run, mutual funds. And that's how people who run other sort of alternative funds end up eventually getting busted for Ponzi schemes, because they don't have the same sort of reporting requirements. They make a lot of claims that can't be checked until years later and that sort of thing. But what I'm trying to say is you probably shouldn't be jealous of your neighbors claiming to have a 200, 300, 400% gain. They might not actually have it. They may not have grabbed that stock when they said they did. They may have bailed when they said they didn't. There's a lot of research that backs that up. But anyway, folks, those are just my thoughts on what's going on in the market today. If we go through a long flat period where the market is down for a year or more, that's when you're going to see your strategies really tested. That's when you're going to see your resolve really tested. And I urge you guys to make wise choices when you invest in a stock, meaning you're looking at 5, 7, 10 years in the future rather than trying to make a buck this year. Chasing that short-term return is something that can be the most dangerous for you, especially if the market turns sour at some point, and it's bound to one of these days. Anyway, folks, thank you very much for taking the time to listen to my wildly unfocused video today. You can tell me how wrong you think I am in the comments below. I look forward to hearing from you. Thank you very much.